Hello and welcome to the CNBC TV 18 special. My guest is someone who has complete command over the financial services sector, Mr. Leo Puri, the Managing Director and CEO of UTI AMC. Well, Mr. Puri, I don't have to explain to you why these are very historic times. If you look at the markets, all-time highs and the magical 10,000 on the Nifty on the anvil, and if you looked at the economy and the banking space, a historic judgment comes from the Gujarat High Court allowing the Reserve Bank and the banking system to set the resolution of NPAs process at high speed. Well, first that, since that is your first love, with the Gujarat High Court clearing the way, do you think that we have reached the end game of NPA resolution?
I would say it's the beginning of the end, and a very auspicious beginning. So the good Muhurat on which to launch the process. I think we were all watching a little bit anxiously to see whether or not there would be yet another attempt to ambush this long journey that we've been on. I think it's a tremendous relief to almost anyone who has the interest of the markets or the banking system at heart that a rogue attempt to once again derail a thoroughly well-intended, well-founded process has for the time being at least been thwarted by the court. So yes, very relieved to see that.
Okay, well, you know the bankruptcy laws well by now. Yeah. Hereafter, you will start seeing insolvency professionals take over stressed companies, and in the meantime, liaise with the creditors to get a resolution. Are you sure that this process, which is supposed to be in 6 months, will happen in 6 months?
I don't think anybody is certain. I think what we are certain about is that we had to try something different from the circular fudge that we were used to in the past. What we have ultimately got to is a stage that says, if the government and the RBI work together and provide some strength to the banks, then we greatly improve the probability that we will actually see genuine resolution of assets. In order to get resolution to happen, the risk of bankruptcy must be real. The purpose and the end game is not bankruptcy. I don't think the idea here is to be vindictive in any sense at all, but the sheer cost to the country of having assets that are stranded and banks that are crippled is frankly unconscionable at this point in time. And from a systemic point of view, we had to essentially figure out a way to break the logjam. I think corporates who are involved in this process will have to make a call. Do they want to fall on the side of continuing to drift towards being, if you like, pariahs in the system and continue in the old way to challenge, block, tackle this process? Or do they want to understand the new reality and the ecosystem which is being created and fundamentally support it? And I think this is, in that sense, a genuine watershed. There are a lot of loose ends to this process. The famous Indian democratic process will ensure that nothing will happen exactly as intended. But rather like, let's say, the GST, the positive energy in favor of this working, I think, will carry it through despite these bottlenecks. Okay.
Well, actually, due credit to the judiciary, they heard the SR versus RBI case in record time and gave a judgment. Even in previous NCLT proceedings or challenges in front of the on the insolvency code, they have not stayed the proceedings even when they have heard the litigants. Do you think the judiciary now is part of the process of resolution in a more constructive fashion?
I think the judiciary understands that this must be given an opportunity to succeed. I think it would be expecting perhaps a little too much to ask the judiciary to entirely abdicate its role as the ultimate. I think it does view itself as the ultimate conscience keeper, if you like, of constitutional process and natural justice, and I think all of those remain important. But I think the infructuous or the so-called vexatious and frivolous use of the courts as a simple and arbitrary mechanism for blocking well-intended efforts at resolution, that was long overdue. And you must remember that many of these assets have actually been created by funds and debt credit. What's unusual about the creation of Indian infrastructure is that it is almost entirely debt funded. You know, the argument that is sometimes made that entrepreneurs have put their skin in this game, and the reason they don't let these assets go is because it was built with their sweat and blood and so on, has a certain amount of truth. But then you have to remind yourself that often there was marginal, if any, equity that actually went into this. So the country needs to recover the ownership of these assets. If the existing promoters are willing to essentially go along with the new normal that is attempting to be created here, then certainly they could continue to run those assets under the new set of conditions. If not, for once and for all, we have to demonstrate, which is normal in any other part of the world, that if you lose the ability to govern assets well and pay creditors, you lose the right to own the asset. It's really no more complicated than that, and I think I'm hoping that this signals the beginning of that process finally coming to bear in this country.
Yes, and I do hope you use the word watershed, and one hopes it is a watershed case and a watershed time as far as bad assets and their resolution is concerned. But now to come to the markets, setting a new high every day. Do you think that at this point in time that is justified, or would you worry about irrational exuberance?
Yeah, as you say, markets have always been famous for being irrational and people stay solvent and so on. But I think we're at this point in a market which is certainly driven by liquidity, is riding on momentum, and is approaching valuation levels where retail investors, middle-class investors who have been solidly committing their savings to the capital markets and supporting them over the last 2 years should actually take a point to reflect on their risk appetite and asset allocation. As a fund manager, I don't think it's our job to be cheerleaders for the market. In fact, it often disturbs me when I see some people in our industry seeing it as their duty to drive markets up, as it were. We're essentially custodians of people's money to find the best possible ways to deploy the trust they put in us, keep it in the markets, and respond to their risk appetite. And what's been remarkable about this cycle is that they have systematically continued to invest, partly based on a conviction around the reform process underway, the change in political climate, and partly, I think, just driven by the dearth of other opportunities. In effect, the gold real estate downturn. Yes. But you know, downturns can happen in any asset class. They've happened in gold and real estate. Of course, it's not so long ago that they happened in stocks and shares, and memories should not be that short, that most asset classes tend to be non-linear, they are cyclical, and therefore the need to review asset allocation is important. Whether we are in a bubble or not, I did read Swami Iyer in the Times saying that we are in a bubble. I think that's a little overly pessimistic, but we are certainly in territory where you have to be extremely thoughtful about where your risk appetite really lies at this point. And it is a time for rebalancing for any middle-class household for whom this is not casino money, if I can use that term, or money that they couldn't care about whether they lost or not, for money that is part of their core savings or a retirement corpus, or who's saving for education or for a goal. This is absolutely the right time to review asset allocation, and if their goals have been met, or if they believe there's a genuine risk to loss of capital, they should rebalance towards either fixed income or balanced funds.
Mr. Puri, you are fund manager extraordinary. No two ways about it. You have very explicitly said that fund managers ought not to be cheerleaders, but I have not seen so many of your vintage or of your candor. Would you say that there could be all the more reason why you should trust a fund manager with money at this point in time, because there could be bottom-up stories even if there are not top-down?
Yeah, that's why I say we are not in a bubble. Of course, you should always be looking at bottom-up stories, and there are different styles in the market. There are fund managers who would value growth, and some who would look at value, if you like, or stocks which are underpriced, which could rise, and others who will keep buying, let's say, IT, pharma, consumer, finance stocks, in high-performing companies where they believe despite high Ps, growth will compensate. And I think these styles should be explicit and they should be linked to the appetite of the investor, ideally. But it's precisely in points of rapidly rising markets that there's a risk of mis-selling in any financial industry, in any investment industry. And this is a time where we do have to counsel our intermediaries, advisors, and so on, that they do have an obligation to be much more sensitive than any other time.
Okay. Mr. Puri, I have to take a break at this point in time, but lots more questions to Mr. Puri on how should an investor or a middle-class investor whom he's referring to approach a market that is at all-time highs, and how he should protect his investments, or at least be prepared for the kind of risks that investments entail. We are back in a minute.